Welcome to TMS Insights. Jeremy and Ben back in the office again to bring you another update. It's July. There's been a bit happening, but not as much as when we last brought you the update in June. Ben, the conditions in the market has steadied through July.
Yeah.
That activity of June, which was a fair bit of selling, has abated. There's a calm that's dawned over the market somewhat while the central banks are doing their thing.
Yeah.
We've had US earnings going on. We're about to receive Australian earnings season. So it's a pretty interesting time for investors.
Yeah, I think, a lot of fund managers were away over the holidays, school holidays, first time we've been able to get away properly. And there's a lot to come. And it's fairly soon. We've got the mega cap US stocks about to report.
Yep.
We've got all the Australian stocks about to report. We've got the US Fed meeting, the RBA meeting.
It's all this week, everybody. Yeah.
You know.
Some of these things will be done by the time you view this, in fact. So it is high noon in terms of market news and stock news as well. So to get a read on it, why is the market calmer? What's calmed the market? Anything?
Well, the main reason is bond yields.
Yeah.
So if clients looked at charts of stocks, what they're probably not looking at is the 10-year bond yield. And it's not just the Aussie one, it's everywhere in the world. On the 17th of June, the 10-year bond yield hit 4.15%. It was 0.8% on the 1st of January. It was just an extraordinary movement. Yeah. And that's why we've seen such volatility in the share market. It's now at 3.3.
Yeah.
And so we have seen a significant reduction in the market's outlook for what rates are going to do. So we're still going to get a lift, but we're either going to get rates starting to drop or the rates are not going to go up as far as expected. That might not be right, but that's what the market's saying.
Well, I'll give a slightly nuanced version of that. The markets have calmed because they believe central banks will fight inflation.
Yeah.
That's the big thing. So in the long run, if they don't, the cost will be greater economically because inflation's a tax on everybody. The fact they're lifting rates is basically good news to deal with inflation. So if they were to try to put their head in the sand, pretend it didn't exist, that long bond would be higher and equity markets be more concerned. So I think it's a combination of those things ultimately, and that's what's given the equity market about a 4% increase in the month of July.
Yeah.
And some of the earnings news, because we'll talk about the Aussie season next, Ben, but let's talk about the US reporting season.
Yeah.
I mean, there's been some, people were a bit nervous.
Yeah.
There's been some numbers today. You said, well, the big caps are coming later in this week.
Yes.
But there's been some numbers that I was quite happy with overall.
We saw a downgrade for aftermarket from Walmart last night. That's probably been the first main negative one we've seen.
Yeah.
We've got a lot still to come, but you're right. And actually, we saw this chart this morning that we might quickly
go to this one,
because I thought this one was interesting, and I know the axes are a bit hard to read, but what it shows you over the last 5 years, this goes back to 5 years, is in the white line, the forward PE multiple of the US share market, the S&P 500, and the blue line is the earnings of the overall market.
Forecast earnings.
And what we can see is that earnings are still at record highs.
This is a record level of forecast earnings.
Yes.
Yeah.
We can also see that the market has got significantly cheaper over the last 6 months.
The PE's fallen a long way. Yeah.
Not to say maybe it was expensive 6 months ago, but you can see what to me is like the disconnect between earnings and the earnings multiple. And that's not necessarily, I'm not sort of saying that means the market is insanely cheap. It would be abnormal if the market's got it that wrong.
Yeah.
The market's saying that earnings are going to start falling.
If we took a snapshot in 3 or 6 months' time, I would almost certainly say the gap will be narrower between those two lines.
Yes.
Which will mean the earnings will come down or the market go up, the PE.
Or a bit of
both. Yeah.
Which is, I think, probably the most likely
scenario.
But you can see that the US market, it's trading on a forward PE of 16 times. That's a attractive multiple. It does show that, with the move in bond yields, we have seen multiple compression.
Yeah.
Because there actually hasn't been, and this is the important point, we are yet to see a deterioration in earnings.
That's right.
But the market has priced that
it in. And it may be partly or more than partly wrong.
Yep.
And the thing for us to talk to clients about is that fear that was clearly going on through June. It now looks a little overcooked, doesn't it? And so it would be quite possible to go back into this space and see some improving scenarios. And so don't start bringing fear into the equation after you've had that pullback,
the size
price
of that
change.
pullback,
and the outlook isn't suggesting that there's all of that there. We're going to take step by step with the data points and see what comes up in reporting season and see how that looks. So you mentioned the Walmart thing was interesting because it mentioned that inflation word, which is probably the one that we're worried about in how it might impact on companies, their cost lines. If we just talk to the Australian reporting season, which when we next bring you an update, we'll be reporting to you on some of the August profit results. And again, this is probably suggesting, Ben, for a 12-month period, there's going to be a few, 10 or 11 at least good months for a number of companies. We'll be focusing, we might say this all the time, on the outlook statements that the companies tell us.
I think so. That's going to be, through to the end of June, we probably only started to see some signs of pain in the economy by May, maybe. So I think you're actually going to see a very buoyant earnings period overall, and probably ahead of market expectations. But we are moving into a different environment. We know that interest rates are going to be significantly higher in the 23 financial year than the 22. We have seen a housing market slowdown commence. We've seen consumer confidence fall, et cetera. So I think it's going to be more the fund manager's attention is going to be more on the outlook statements as opposed to what's happened over the last 6 months. But again, the market has priced in a deterioration in earnings that is yet to be seen. And that's happened here as well as America.
Right. And we know some of the factors that have caused concern are movement up in commodity price, energy costs, but we've also seen some of these come down in recent times. I mean literally the last few weeks. But there's been quite a decent pullback in oil, iron ore, ag commodities, wheat, copper. Copper, which they call Dr. Copper, and they talk about what it means. It's fallen a long way. So these are things, again, what we're interested in is not a day's movement, a week's movement, sustained levels. And
I'll just go back to the original question you had with there, Jeremy, was why is the market calmed? I think one big thing to be aware of is that, and there's always reasons to be in the short term, bullish, bearish, neutral, whatever. But the reason I think at the moment you'd be wary about the market is that we are yet to see any country start to chip away at inflation or get on top of it, despite the rate moves that we've seen. The reason you'd be positive, I think, at the moment, and why I think you're seeing these things start to move, is that the price of computer chips, shipping, steel, timber, wheat, has all started to, and not small falls, it started to fall.
Large falls from big rises.
Yes.
And I think that's really well said. That's why the market would be, you can be concerned if you want to be, or a bit more relaxed if you want to be. But again, nobody's going to have a perfect vision on what the next part looks like, but that direction's encouraging. And that's what's important. What inflation is mysterious, and this is what we haven't seen in a good generation or two, and so people don't know exactly how to react. It takes a bit of time to unpack it and put it back in the box. So we're still seeing some of the impacts coming through now. But, and this was central bank's case a year ago, it'll be transitory, it'll move through. It certainly looks like it's a bit more than transitory. It's not concluded that it's permanent, and it won't be, I don't think, because of their actions. So you are seeing synchronised increases in rates, which will have a monetary impact. So, look, again, we'll be seeing more rate rises coming up. We have the RBA meeting next week. That'll be coming through. We know that the Fed will have its month off and then back again in September. But from an equity point of view, we think we want clients to be, focused on good value opportunities, not to get bearish after you've seen such a pronounced sell-off, and to be thinking about what the outlook statements say about the year ahead.
And I think it's always the key, and I know we keep coming back to it, but as long as you are in businesses that you think over the next 3 to 5 years can continue to grow their earnings in many cases, those businesses have just got cheaper.
That's
but
right.
there are a lot of businesses out there that will be hit by, the things going on. And it's probably one thing we've been trying to do is just keep increasing the quality of portfolios because it has been indiscriminate, particularly the end of June was really just across
tax loss selling.
Yeah. I think there's a lot of mandates moving around.
Institutions,
forced selling, so it was a funny, weird, choppy time, not a fun time. But I feel like, sort of going into the second half, there's growing signs to be a bit more confident.
Yeah.
And definitely just the drop in volatility, I think, is a welcome thing.
It makes it harder for us.
Yeah.
Big swings every day, but no, you're right. So that's great. Good update from where it positions ahead of this big period we're about to come into. We look forward to bringing you that news from the Aussie reporting season in August, which we'll do over 2 instalments. Thank you.